So today I'm going to do the most popular video series that I do on the YouTube channel, which is the UK stocks I'm buying December 2025. I cannot believe we are at the last one of the year, but this is the most popular video series that I do on the YouTube channel. Anything I buy on the UK stock market or sell on the UK stock market will be in this video here today for you guys. Just keeps that transparency up, so any move I make, it's on here. You can go back years now and track my moves and see if they worked out or if they didn't work out. And I think that's why it's so popular. I don't hide anything like other YouTubers. It's all on this video for you guys. So there was 5 UK stocks I bought, which was a little bit maybe slower than what I would normally do. I think maybe a little bit of cautiousness coming in because of that budget potentially. And there was 2 stocks that I, trimmed the position on in the UK markets. I will do the US one for you guys in a few days' time as well for you guys that like the US stocks. Apart from that, all I ask is if you could hit that like button so it pushes the video out on the YouTube algorithm. That would be absolutely amazing. And apart from that, let's get stuck on today's video. Now, just before we do get onto the stocks that I've been buying and selling, if you do want to join the private group, guys, the Black Friday deal, we are down to the last 2 days. On Sunday, it is finished. It is done. No more Black Friday sale. If you do want to join the private group right now on the Black Friday sale, guys, gets you access to the Discord, £44 for the full year, over 100 exclusive videos, get to see what I'm buying and selling in real time on there, and a Discord community with 600 members on to talk about stocks, including me, guys. Remember, the prices are going to be going up in January as well to reflect the performance of the year-to-date returns, guys. So this is your last weekend to take advantage of that. And if you do want to start investing, why not join eToro? I'm currently a popular investor on eToro. You can join with a link in the description, and you can see here that we're currently up 35% year-to-date, which is obviously pretty decent performance. So let's get on to the stocks that I have been selling on the UK markets. Well, I say selling, I trimmed 2 positions. So the first position I trimmed was Audio Boom. This has been a really good performer for us this year, a brand new stock into the portfolio, and it really kicked on very well this year. And what was really nice is we had the initial rally, and then it gave us a second opportunity to start buying this stock at the £3 range between May and July time, which was absolutely amazing. Now we've seen the rally happen in Audio Boom. Obviously, the rumour is that they're going to get taken over potentially. Now, the thing is that I look at the valuation that Audio Boom is at, and 2025 numbers is 37 times earnings, 2026 numbers is 26 times earnings, and I'm looking at the run that it's been on, and this stock is pricing in basically a takeover. And if the takeover doesn't happen, I think there could be a significant drop. And as well as that, I think the valuation it's trading at for the numbers it's doing is a pretty rich valuation. And I think the reason why it's such a rich valuation is because of the potential that this takeover is going to happen. So if the takeover was to collapse, I think we would see a bit of a decline. And just to protect myself, I've been taking a bit of profit off Audio Boom now and then. I've kept a significant amount just in case the takeover does happen and I get that nice 30-40% premium. But for now, I'm just taking a little bit off the table. So I did trim my audio position twice during last month, which was a 10% trim on Audio Boom for a 92% and a 10% trim for 102% on Audio Boom. So number 2 as well is Airtel Africa. So this has been a really good performer in the last year. You can see here that the stock is up 193%. I did decide to trim my Airtel Africa position by about 5%, and that was for a 201% return, and that does exclude any dividends. I do like the company. I am very tempted to hold this for when it spins off its mobile money platform. However, with the risk of the FX impacts and fluctuations, and that could come at any point, I feel like I want to take a bit of profit off the table with the run that it's been on, and that's what I did. I will think about probably releasing the rest of my capital in Airtel Africa once the mobile money IPO has been done in the first half of 2026, I think. Now, moving on to the stocks I bought. So these are all the stocks that I bought between the 1st of November to the 1st of December. Starting with number 1, Greggs. I have been buying Greggs. I think this is a cracking opportunity right now in the stock market. There's been a little bit of a bounce in the last couple of days, up about 7%. However, that does not make a big difference from how much the stock is down at the moment. Now, I only started buying this stock around 2 months ago, so I've got a pretty decent average on Greggs at the moment, and we're seeing a pretty significant dip. You can see here it's now pushed lower than where it was when we had the mini budget disaster in 2022 with Liz Trust, and you can see that we're actually pushing nearly now to the COVID lows, which is incredible. You think about the fear that was in that time frame, the pandemic, all the shops shutting down, are office workers ever going to go back again, the work at home situation, and now Greggs is at those sort of levels, which I think shows how much negativity has been priced in here. You do get a nice 4% dividend yield as well with Greggs, and I'm sure it's one of those that doesn't need that much introduction. They have one on a lot of high street corners. I'm sure there's a few near where you work. Greggs, a lot of people always say they're near saturation. They can't open any up anymore. I've heard that argument for many years on Greggs, and you know what keeps happening? They keep opening up more and more stores, and they keep growing the profit and the revenue. If we go on the past performance of Greggs, you'll be able to see here what a performer it has been. Look at that revenue trend, look at that profit trend. Absolutely beautiful from Greggs. Now, if you look at the recent financials, I actually don't think they've been that bad. Total sales is still up 6% at the moment. Like for like is up 1.5%. Yeah, we might want it a little bit higher than that. It's not terrible at the moment, but the full year outlook at the moment is unchanged at the moment. And like we said, we've got a company here trading at around about 12 times this year's numbers, 11 times next year's numbers. This is a company that historically has traded more towards a 20 times earnings multiple business. Now, I think Greggs is realistically probably more like a 17 times earnings, but 17 times earnings, a metric expansion from 12 times earnings, that's a pretty nice upside you got going on there. And we are forecast to see the revenue keep going back into the right direction. Profit is expected to start going back up in the right direction through the likes of the partnerships, through selling some of the frozen sausage rolls, through the likes of Tesco, extra products, new stores, and also you do get a company here with a pretty decent balance sheet. If you look at the balance sheet here, they've got 6.2% debt to equity and a nice little cash balance that's going on there at the moment. Now, I guess really, why is Greggs down? Why is Greggs in this position? Now, if you look at Gemini, they put a few points out, like a profit warning here. They said that that was due to the weather impact that they had. We had quite a hot summer. It seems a million miles away now, doesn't it? But we had a pretty hot summer, and that really hurt the sales. They said that there's a slowing growth rate at the moment. They said that investors have re-rated it at the moment. I think they've just fallen out of love with it at the moment. And it is shorted. It's a very highly shorted stock, which I don't know who is shorting Greggs, because if you go past them on the high street, it must be some American investors, because you guys know from the UK, you go down Greggs, you put a new location of Greggs down anywhere, there's just a queue the next day, isn't it? People absolutely love it. People are not going to be giving up on their cheap coffees and the cheap bacon sarnies in the morning, are they, anytime soon? But yeah, I think it's just way too sold off. And what I'll add on to this here on why Gemini say that Greggs is down is that I also think they've had the shoplifting, which I think they'll resolve by putting things behind the counter. I think they've also had a few things that have impacted them, like the macro environment being a little bit weak, maybe people spending a little bit less at the moment. Hopefully that helps people, or that resumes to more growth towards next year. The other thing as well I think you have going on, Greggs, is they've put a lot of investment into the company. So they've got a lot of like fulfillment centres opening up next year. And obviously that investment has, from the cash that they've been investing, will hopefully help them with the likes of the profit margins, the amount of products they can make. So I think that is also a benefit that will help them in 2026 when a few of these new fulfillment centres and distribution centres start opening up next year as well, which Gemini isn't picking up there. So yeah, I think Greggs is just way too sold off. I think financially they've still been doing okay, and I think the little dip that they do have will rebound, and I think the valuation you're picking it up at, I know. I go in 2 years' time, I know there's going to still be a queue out of Greggs door. So that's absolutely fine for me. Moving on to the next one. So number 2, JD Sports. So this has had a pullback significantly. You can see really since October time, the stock at one point was down nearly 30%. It's had a bit of a rebound in the last couple of days, but nothing too major compared to the dip that it's on. And we saw like the tariff situation pushed it down to 60p, and then we eventually had a bit of a run up. Now, I can't believe it was only last month that JD Sports was featured on the stocks I'm selling. I don't know if you guys remember, but I said to you, I'm just going to take a bit of profit off the table here, and I'm glad I did. And now the stock has fallen this much. The shares that I sold I bought back in at these sort of levels, which I'm surprised it has fallen down. Now, JD Sports, bit like a Greg's, it is having a few issues, but it's been an absolute solid performer on the UK markets. Over the all-time, it's returned over 2,492%. The latest financials came out the other week, and I thought they were okay. North America did show some signs of improvement. Europe did not. UK did not. Asia did show some signs of improvement. So at least there was some steps in the right direction. But as we know, someone like a JD Sports, the consumer's absolutely weak. You know, you look at Nike, look at the issues that Nike have had. Now, it's not a coincidence that all these companies are having a dip at the same time. With the consumer at some point, hopefully starts bouncing back, and these companies will do well when it does have a bounce back. The other catalyst that you do have is you have a FIFA World Cup coming up, and JD Sports now, most of their revenue, the majority of their revenue now, over 50%, comes from America. So they've opened up all these new stores in America in the last kind of 7 years-ish, and now that they've got a World Cup going on, hopefully the consumer feels a bit better, like for the interest rate cuts coming in the US, and we see JD Sports have a bit of a bounce back. And for now, I'm paying 6 times forward earnings. I'm taking this risk at 6 forward times earnings, which I think is a very good risk to be taken at these sort of levels. And if they do get to these levels of profitability, where they're doing 600 million in profitability a year, I mean, that's significant on a 3.8 billion market cap. And you look at the balance sheet as well, they've got a pretty decent balance sheet, around about 20% debt to equity. So yeah, really happy with the balance sheet. And I think there's also been some insider buys, or it might have just gone off. I think there was some insider buys, but that has just, the CEO bought some shares, but it must have just gone about 12 months ago. So yeah, I think JD Sports at the moment, with the catalyst of the World Cup, interest rates, consumer gets better, the valuation here, yeah, I am happy to add into some JD Sports. Moving on to number 3, Bloomsbury Publishing. So this has had a bit of a tough year, down about 25%. And I don't think it's any fault of its own, really. I think it had a lot of hard comps from the last year. It had a lot of major book releases from some of its key authors. Haven't got it this year, but in the next few years, we're going to see, once again, those new releases coming from the authors. And I think the sell-off that Bloomsbury has had is maybe just a little bit too much. You do get a nice 3.14% dividend yield. As you probably can tell, they are a book publishing company through a few of the authors that they do have. Now, if you look at the latest press release from them, what was the standout is the growth into academic and professionals. That's growing 20%. What you also have as well is some of their authors, or the best-selling authors as well, have signed multi-film deals with Walt Disney for some of their books to be turned into films. Now that's great, because as we know, when some of these books come films, it brings in a new audience, and when the people watch the films, they might go out and buy the book, or when an author brings out a new book, they go, oh, that's so-and-so that made that film that was really good, and they go buy it, and there's more demand for sequels or new book releases that do come out, so that's great. They delivered a full year profit ahead of expectations as well, and we're also expected to see the main contributor, or the main author, the star author, which is Sarah J. Maas. There is the potential that she is going to be bringing a new book out in 2026 or 2027. So this as well, it will really help them when that happens as well. I think even on the announcement that there's going to be a new book coming out, it managed to get her old book back to the #1 best-selling book. That's how much demand there is for Sarah J. Maas. The other thing as well is they have released a Pocket Potters, because they do have J.K. Rowling as one of their authors as well. And another catalyst that you're going to have is their Harry Potter TV series that's going to come out in 2027. That's going to bring a new audience into the Harry Potter books, and that might mean that old titles sell very well, but also these new books that are the Pocket Potter books hopefully perform very well with the potential of this new TV series coming out. That puts Bloomsbury down to about a 12 times earnings, and for a company that has a pretty decent track record of delivering revenue growth and profit growth, if we look at Simply Wall Street, look at that performance there. You also have a very healthy balance sheet, which they sometimes do use for acquisitions, around about 7% debt to equity, which is also pretty good going. You also have a couple of insiders buying the shares at the moment. 12 times earnings for Bloomsbury. I like this one, and there's a lot of key catalysts coming up for it at the moment as well. Number 4, so it is Zotefoams. Now, I don't know what happened with Zotefoams, but at the start of November, the stock just fell 20% off a cliff. No reason why. It just decided to fall 20% off a cliff. They brought out a update on the 4th of November, and it was solid. It was in line with expectations, no surprises at all, and yet the stock just decided to fall off a cliff. So once again, I was selling a couple of shares in October time on the last month's video, November time in the last month's video. And I was thinking, well, we'll see what happens. And then it dropped 20%, and I bought them all back. I thought, okay, if you're going to give me a 20% dip for no reason, I'm going to buy some shares. Now, for Zotefoams, they've got a new management team in, and the management team look very keen on delivering some very good financials. The targets at the moment, what they set out in 2024, is to grow revenue at a CAGR of 7%. They're expecting to grow the operating profit faster, so metric expansion going on at a 17% CAGR. Now, you might be able to tell from Zotefoams, they do sell foams. They do that into the likes of the transport and smart technologies, consumer lifestyles, constructions and other industrials as well. So hopefully as they open up new facilities in the likes of the US, as well like interest rate cuts, the economy goes back to decent amounts of growth, they are benefiting from that situation. They also have a key partnership with Nike. So they do provide the foams that go into the Nikes. They are the exclusive provider of Nike as well, and they are in the high performance end. Now, if any of you guys do know Nike, you'll know that the only successful part of the business at the moment for Nike is the running shoes. That is one of the only areas that's currently growing for them, and growing at very good rates. One of the key reasons why is because of the performance, and the performance for some of that does come from the foam aspect. So that's a key partnership that they do have, and looks like it's going very well. It's going that well by the sounds of it that they've decided to expand into the manufacturing side in Vietnam to have closer ties to Nike with this partnership that they do have at the moment. Now, even though it's had a drop, and since then maybe even a bit of a slight rebound, the valuation still looks pretty decent. I mean, 2025 is about 13 times earnings, 2026 is 11 times earnings, and for a company that's expected to grow 7% CAGR or even operating profit even faster than that, yeah, you'd be talking that this company should be about 15 to 18 times earnings, which I think is very, very fair for a company at doing these sort of levels. You do also get a little bit of a dividend of 1.8%. And if you do look at the past performance, it's been a pretty decent past performer, pretty decent balance sheet as well. You're sitting around about 24% debt to equity and a little bit of a cash pile sitting on there. And the management team did buy some shares, although that was around December, April time, and the stock was around about £2.30, £2.50. And since then, the stock has had a bit of a bounce, but at least they've got some skin in the game. And that takes me on to the last stock, number 5, Manolete Partners. So I have been added into the Manolete Partners position. That did have a drop through this last month, and I just thought I'm going to continue buying into the stock. If you don't know, they are a litigation firm, and if you know what happened in the solvency market, basically, you know, if companies are having these cases, they buy the cases, they take them on, and then when the case is settled, then obviously they take the commission from these cases. Now, basically, in COVID, the government stopped companies going bankrupt for 2020 to 2022. So if you're someone like a Manolete and you handle insolvency claims, then obviously that's not going to be a great environment for you. But then in 2022, the government turned all the support tap off, and then we saw the surge in the amounts of cases that are happening. And as well as that, the environment in the UK has not been good. We've seen consumer confidence, the cost pressures that have been happening through inflation, extra taxes that are going on at the moment. The amount of insolvency cases have been increasing massively. And in that sort of environment, you would expect someone like a Manolete to really benefit from that. Now, they brought out their earnings, which caused a 20% drop on the 19th of November. And the reason why it dropped is because you look at the headline numbers, revenue growth was down 12% and EBITDA down was a significant amount. The reason they put this down to the decline in numbers here is that there was a lower than average case settlement. So if you're getting, let's say the case is 200,000 and Manolete take 10%, you make 20k from it. Let's say the case is valued at $500,000, you take 10%, you make 50k from it. So just naturally, if the case amount that's being settled it just bad timing that some of these case values are lower, you're going to make less money from it. And that's something that is the case. I shouldn't have said case. That's sometimes the issue with Manolete, is that because it is open to fluctuations with the amount of case, it's hard to predict when they're going to close some of these claims that are going on, and because of that, the financials can be a little bit choppy, and that's what has happened at the moment. Now, I did think it was a little bit sneaky because they don't mention it here, but in the premium broker numbers, they actually snuck out a profit warning. So if I go on Stockopedia, which you can sign up with the link in the description as well, guys, with I think it's 30% off you can see here that EPS was downgraded for 2026 from 4.7 down to about 2.5, so they're half the EPS, which I thought was a little bit sneaky not to put it in the RNS. Well, it's not sneaky, it's a bit disgusting, really. You should, this information should be publicly available. So yeah, anyway, so they snuck out a downgrade to the profit guidance, and they also did a 2027 downgrade from 6.8p to 6.3. So I'm thinking, well, why are you downgrading that guidance if it's just a short-term impact? I didn't really like that there. But saying that, I'm happy to still buy, because if you look at the actual case amounts, so they did have new case referrals of 15% and case investments of 15.9%. So it's not an issue that they're struggling for cases, because you can see here they're increasing at good rates. I generally just think it's a timing issue of where these cases have closed, which sometimes can be a little bit hard to predict. And the fact that when I look at the risk to reward here, and the market shoved it down 20%, and if they do hit the next year's numbers of where they're expected to be in profitability, 10 times earnings is fine for me, because look at the forecast of the revenue growth, look at the forecast of the profit growth. 10 times earnings is fine for that sort of valuation here. And if you look at if they get anywhere what they were doing before the CV situation, they used to have like 30% profit margins, and they were growing like a weed. So even if they get to somewhere like half of that, and they're currently doing 43 million in revenue, I mean, on 2028 numbers, it's 5 million in profit forecast on a 29 million market cap. You'll do well from this. So I am a little bit frustrated that they weren't so honest about the downgrade in the outlook, and I don't know why they've done a little bit of a downgrade to next year, but they're still signing new cases. I still think they're going to hit the full year guide when these cases, when they sign them, take 12, 24 months for them to start flowing into the financials. So when they do start coming into the financials, I think we'll start seeing what the analysts are forecasting here, where there's a big tick up. And when you look at the valuation of a 29 million market cap, if they start doing 4 or 5 million on a 29 million market cap, this should do quite well. Never mind if they get back to the levels of where they used to do, what was it at the peak, 8 million of profitability. So yeah, I'm happy to hold this at the moment. I will say that I would be a little bit happier at the moment if they did launch a bit of a share buyback at these levels and give the shareholders something. But yeah, that's the fifth stock on this list. So I hope you enjoyed the video, guys, and hopefully there was some useful ideas for you to take a look at. Once again, the Black Friday sale, guys, it is running out on Sunday at midnight. So it is your last chance to get in now. If you do want to join it, send me an email, jkinvesting@gmail.com, guys. Apart from that, thanks for watching. See you in a bit.